think gold is the place to go right now. Gold's had this beautiful pullback. It's kind of trading down today pretty decently. But if you look at the larger picture, gold is doing exactly what it did during the 70s before a run from about $100 an ounce to $1,000 an ounce. Now, I don't think you're going to see a 10x on gold, but I think a 5x or a 3x is very, very possible. So yeah, I definitely still think we're in a bear market. I mean, the longer term trend on the S&P 500 is still fully intact. Like you mentioned, the July, August high, we still haven't even come up to close to testing that. In fact, let me show my screen here so we can kind of take a look at the chart itself. So this is the SPY, which is basically the S&P 500. And what you can see is the long-term downtrend from the high on the spiders is still fully intact, and we still have a decent distance to go. So for me, as long as we're below that line, the downtrend or the bear market is fully intact. Now, one of the interesting things you can see here is that if you take the 2020 low and connect it to this pivot low, look at how we broke that line, but now we're coming back and kind of testing that area with resistance. So it's a great day on the markets. I think today it's a sigh of relief for the markets. And what I mean by that is, we saw Meta's earnings, we saw Google, we saw Microsoft. I mean, it was just bloodbaths everywhere. Then yesterday after the bell, we got Amazon, and that was a catastrophe. And then Apple reported, and it was going down, and then it reversed, and now it's having a big up day. And everyone's like, oh, thank goodness, like we just avoided a major accident or collapse in the stock market. And so now you have a scenario where the big earnings of the trillion-dollar companies are over. The market now is going to focus back on the Federal Reserve. And I think there's this air in the market where the earnings have been so poor that the market is really hoping that this is where the Fed will say, okay, we're still hiking 50 or 75 at this November meeting, but afterwards we're going to take a pause. We see the economic data. We see that the earnings are getting really hammered here. So let's wait for a few months. And the market is craving that pause so badly. So I think the justification is multifold. So number one, I do think that a lot of the economic data is lagging a little bit, like the jobs numbers. We know jobs numbers lag. They've been strong, but I do think you'll see this kind of cliff dive in jobs numbers coming out here soon, maybe as early as next Friday. I do think that if you look at the PPI data, it's starting to show that we're seeing a reduction in inflation. And remember, the producer price index leads the CPI. So producers kind of see the inflation coming down, and then eventually they pass it on to the consumer. So there's kind of this 1-2 punch there. And then I think that the Fed, you have to look at what we saw with the Wall Street Journal article a couple Fridays ago where they kind of said, hey, the Fed's going to raise and then pause as well. And the Fed has used the Wall Street Journal as their conduit to try to kind of give the markets a heads up. And so I think that was important. And I think more than anything, you have these central banks like the ECB, the Bank of England, the Bank of Japan. Their economies and their currencies are almost at breaking points because the dollar has gotten so strong so quickly. So it's not so much that the Fed, I think in a perfect world, the Fed would want to continue to raise, but they have to be careful here because they could literally cause a systematic breakdown in the global system if the dollar continues to get too strong. So, I mean, when we talk about a breakdown like this, we're talking about things like, Credit Suisse. We saw that collapse. I mean, do they just have a bunch of derivatives that just start to go bottom up or turn over and go bankrupt or go to zero? I mean, you look at certain breakages because there's just so much pressure on these other systems. And everything's been built on this house of cards of cheap money or free money. And so when you raise interest rates as fast as the Fed has done, it's inevitable that there are certain assets out there that can't handle that. Investors are pulling back from the bond market or from bonds. Bond prices we've seen bonds declining because interest rates are going up. The stock market was cratering until recently as well. And you look at other things like what the pound was doing against the dollar, what the yen had been. The dollar yen was just surging as the yen was declining. And so there are breakages that will occur because it happens too fast. And I think what investors don't understand is that if you go back to Volcker, Volcker raised interest rates. I think he raised from like 12% to 17% in a very short amount of time. That was a 50% hike in interest rates. But if you go to what the Fed did, the Fed raised from 25, a Fed funds rate of 25%, 0.25%, so 25 basis points, to now 3.25, potentially 4% after next meeting. How many hundreds of percentage points is that to hike things, right? You're talking about hundreds of percent. And that is meteorically more detrimental to the system than what Volcker did, even though Volcker raised a total of 6%.
I think those are very good points there. And as we see then the impact on the markets here, what is your long-term outlook? We're looking at the S&P 500, the ETF there. But what is your long-term outlook? And for people who bought near the top there, how long do you think it'll take until we get back to those levels?
Yeah, so I do think there might be a little bit more near-term upside in the S&P 500. It wouldn't be shocking to maybe head up to 390 on the spiders. That would be around 3,900 on the S&P. I even think 4,000 we could test. But I do think that at some point, and this is going to be what the market's not prepared for, and this is where I see the next big leg lower, and then I'll get to like my really long-term projections. But basically what I see happening is the economy is going to fall off a cliff. And the reason why I say it's going to fall off a cliff is because you've had consumers that have been very resilient. They saved money during COVID. They've paid down credit card debt during COVID. And now they're basically spending that money because, number one, inflation's high, so they have to kind of spend some of it. And partially they want to travel. No one likes being locked down and kind of hunkered down in their home. So they're traveling, they're doing this, they're doing that. But eventually that money runs out. Eventually those credit card limits are hit again like they were prior to COVID. And all of a sudden the consumer is going to be like, whoa, I gotta pull back on my spending, right? And in addition, look at all these publicly traded companies. They're either saying we're going to slow hiring dramatically, or many have said we're cutting 10% of our workforce or 20% of our workforce. And so there's a storm brewing here where, again, the Fed has been going gangbusters on hiking because the data has been strong. But I worry that at some point we fall off that cliff. And the detrimental part to the stock market is going to come when you basically have the economy fall off a cliff, inflation is still pegged. Let's say it comes down from 8% to 4%. But even when we're in a recession, how does the Fed print trillions of dollars with 4% inflation? I just don't see how they can. But the market is conditioned to assume that they will, right? So if you go back to every downturn, the COVID drop, the 2009 collapse, all these things, the market is conditioned to say, okay, Fed, bail us out. Well, we're going to get into a recession, and then the Fed is going to say, hey, guys, we're not printing money. We can't with 4% inflation or 5% inflation. And that's going to be a huge wake-up call to the equity markets. And you're going to see a prolonged bear market. And this is getting into that longer-term projection. I don't think we're going to make new all-time highs for at least a decade. Yeah, absolutely. So before we get to value plays, I want to show you a chart, and this is kind of very similar. In fact, before we do that, let's just look at the S&P 500. So number one, look at this monumental run since 2009 when the Fed was printing money. Look at the vertical nature of the market, right? Just unbelievable. Like even if you go back to the .com period here, it still was nothing like we experienced in the last really 13 years. Now, if you want to look at a chart that's very similar in start and see what happened, take a look at the EWZ, which is the Brazilian stock market. So in 2002, the Brazilian stock market had a very similar vertical move to 2008. And then look at what's happened. We have never gone back even close to those all-time highs, and it's been 14 years. And so I do worry that this is the market of the future for the S&P 500, where we do have mini bull markets in the mix, but ultimately it's going to be a long period of digestion of this. As long as the Fed's not printing, the market has to come to grips that it has to figure things out on its own. And like a kid that gets spoiled, I have a hard time believing that the economy is going to be able to figure it out. Now, having said that, like you said, where am I putting money to work? So I'm a big believer there's always places to make money. So, I mean, number one, I think gold is the place to go right now. Gold's had this beautiful pullback. It's kind of trading down today pretty decently. But if you look at the larger picture, gold is doing exactly what it did during the 70s before a run from about $100 an ounce to $1,000 an ounce. Now, I don't think you're going to see a 10x on gold, but I think a 5x or a 3x is very, very possible. So I think gold is a place to go where you'll see amazing returns in this kind of otherwise negative investor market. And then I also think like the EWZ, like we just talked about, if you look at this, now it hasn't broken out yet, but if you look at this, it is kind of coiling, right? This is what I would refer to as a spring that's coiling. And if it can break above this $36, $37 level, that would be a huge opportunity with a lot of upside. So that's a place. And then if you look at other value plays, like I love stocks that everyone hates. And there's no better stock that everyone hates right there than Meta. So Meta, again, everyone's saying, oh, Zuckerberg, he's crazy. He's spending way too much on the metaverse. What if he actually has a plan here and the metaverse becomes something major and basically Facebook has built it or Meta has built it? This at these valuation levels offers, to me at least, a low risk, high reward opportunity, even in a longer term bear market. So there's always places to go, right? I think that's the beauty of it, is that, you can always find opportunities, and I think this is a good example of it. Yeah, sure. So number one, you have to understand with gold is that it's traded in US dollars. So as the dollar has rallied, gold automatically will come down, right? So the key to kind of gauge the analysis on gold and how is gold performing is to say, okay, how much has the dollar rallied in 2022? And the answer is about 20%. Well, how much is gold down in 2022? About 7%. So in a perfect world, gold should be down equal to what the dollar is up. So the fact that it's only down 7% is actually showing you accumulation. So that's a very big positive for me on the longer term here on gold. It tells me smart money is buying in. And then also, if you look at this chart, you had this nice little double top up here, but really what you're doing is you're consolidating inside of this bigger move. So I do think in a worst case scenario, you come down to about $1,550. But again, for me, as soon as you see the Fed saying we're going to have elevated inflation for a longer period of time, but we can't print and the economy is going to go south and all this other stuff, I think that's where gold actually starts to really outperform. If you look at the late 70s into the 80s, it was towards the end of the period where gold really took off. So I think you're in that kind of scenario. Yeah, and I see that 1350, like that's basically taking these pivots here, right here with these pivots. But I'm looking at this level here. And then also, if you're looking at it in terms of a retrace, this would be about a 618 Fibonacci retrace from down here to these highs. So that's kind of a standard pullback. And it's just hard for me to imagine that if you look at the Fed going to, so number one, we're getting very close to a pivot where at least they're not hiking anymore. Maybe they're at zero hikes, but not lowering. But that alone should cap the dollar from going up dramatically. And as soon as you see a pullback in the dollar, that'll also cushion gold and start to lift gold up. So for me, 1550 is my low end with the fibs and different retraces. But again, we all know I could be wrong. But that again is basically to suffice it to say that on the way down here, I'm a buyer. I'm continuing to accumulate gold on the long side.